Well, greetings to all my investment clients. My name is Walter Mazers, your wealth manager, CPA tax advisor. As you can see, the background's different. I am not in my office recording this video, actually in Grand Rapids, to celebrate our daughter's graduation, Dave, from Grand Valley. So, obviously, wishing her all the best in her new adventure in life. She finished wildlife biology. She's loves nature. That's her passion. So, hoping, wishing her much success in her new endeavors and career. So, let's get into uh, the stock market. Um, as I always start out with the weekly recap. Again, remember we're comparing S&P 500 to QQQ. So S&P 500 is right here, kind of in this bluish gold and QQQ and TLT. And these are very, broad asset classes that I want to compare to see how they're reacting to each other. So if we look at one day, meaning Friday, yesterday, uh, QQQ was up 1.2%, SPY zero point 0.7. Long duration bonds were also up zero point 0.7, and gold actually was down about 1.1%. If we kind of look at 5 days, so a week, remember last week we had that huge bump, kind of a in the stock market, pretty much all indices, QQQ, S&P 500 went up, even bonds did well, but gold actually went down by almost 4.4%. So it went opposite to what the market is doing. If we look at 6 months, again, the thing that really stands out is gold has done extremely well over the last 6 months, where the markets are trending down. And again, if we look at 1 year, um, we can see the stock market is trending down. It's trying to find a direction right here. It went down, it went up, it's going down, back up. Really, we don't know which direction the stock market is going to go, but the technical analysis that we're getting is the trend is right now has reversed. Rather than trending up, meaning of the market, the trend is down. The probability of a market, a larger pullback is getting higher and higher and higher. Again, these are probabilities. Nobody knows for sure. Again, as always, looking at 5 years, we were kind of in this bull market, but as you can see clearly, that trend has been broken. Gold has been going up, but again, people say, well, Walter, why not? Why didn't we get into gold? We were in gold the last year, but then there was a pullback. You don't know when there could be a huge pullback on gold because, again, historically, if you look at, people think that if markets correct, gold is just going to go the opposite. Not necessarily. Historically, gold has also pulled back significantly, 20, even 25%. So right now, kind of everything's overvalued, especially gold. Everybody's piling into gold, but if there is a pop in the stock, when I say pop, a trend up for the next maybe week or 2 or 3 weeks, this could be the last hurrah of the upside for the stock market. And then again, technical analysis is saying there's a storm brewing in the stock market. They could pull back, 20, 30, 40, 50%. Nobody knows for sure. Just remember, just as a reminder to my clients, we are out of the market. We're sitting on the sidelines, earning about 4.3% in a short-term U.S. Treasury bill. So It's kind of like I compare, we're on the shore watching a storm out at sea, and we have to wait for that storm to settle, as we really don't know at this point which direction the market is going to go. Again, high probability markets will continue to go down. Could be a huge correction. So in that, as I keep saying, that doesn't mean we can't make money for our clients. Actually, that creates tremendous opportunity to make money for our clients if you're in the right sector. And really, the two things first is going to be long duration bonds. As you can see right now, if for the last really 5 years, it was a poor investment. It's down about 46%. But at some point, if we look at long duration interest for 1 year, uh, it's really started to last year, uh, really in July, August through September, it was trending down, meaning interest rates were going lower and bond values were going higher. But then it reversed and it's heading higher, and then it started to trend down again in March of 2025. Another trend down in April, and then it shot up because of lots of uncertainty with tariffs, economic data. So there's no clear direction right now, short term, which direction interest rates are going to go. So it's too early to go into long duration bonds. So again, we're waiting for that opportunity. But if we look at 5 years, remember this is COVID. And the Federal Reserve, because of economic distress, lowered interest rates almost to zero. And at that point, that was that was a great time to be in long duration bonds. Meaning, prior to that, if we look at all the history of what interest rates were doing, again, the trend started in '08. That was the financial crisis. Interest rates started to go down and down and down. There was that trend down until 2020. It was pretty much at 1%, almost zero, and then it reversed. So the question becomes, when is this trend, a sustained trend, going to start in lower interest rates? And again, it's going to be based on economic data, and right now the economic data that we're getting is not good. Yes, what Trump, as far as trying to negotiate fair tariffs with other countries, is causing lots of uncertainty and short-term interest rates to go up. But at some point, the economy is starting to, economic data is definitely weakening. It's slowing down, and those are not good signs. What interest rates and the long duration bond interest rates are saying is, hey, all the Federal Reserve is going to be forced to lower interest rates because of economic growth is slowing. So a recession, and really there is no signs of inflation. As one economist says, the best cure for high inflation is high prices. Meaning, what does that mean? Sounds counterintuitive, but high prices, people stop buying, and that causes a recession, a pullback. So let's look at, because this is going to be very important coming up this week, meaning some very important economic data. The big one is going to be Wednesday, um, April 30th, GDP. That reading is going to drive the market either higher or lower. Many experts are saying GDP is going to potentially be negative. If that's the case, that'll most likely drive the stock market indices down. Why? Because again, the stock market was pricing a soft landing, kind of no recession. but unfortunately, the economic data is not good. Other things, April 29th, we'll have consumer confidence reading. Again, that's been trending, unfortunately, down and down, not in the right direction. Um, ADP employment, again, April 30th. Um, that's going to be big news. So lots of news coming up at the end of April. Um, Consumer spending, personal income, PCE, which is inflation. So Wednesday the 30th is could be a very pivotal day in the stock market, depending, there's pending home sales, and then May 1st, initial jobless claims, um, then S&P final U.S. manufacturing PMI, ISM manufacturing, construction spending, auto sales. So tons of information coming next week. And then Friday, May 2nd, non-farm payrolls, U.S. unemployment rate. So tons of economic data, and if that turns out to be negative, the market is not going to like that. So there could be a pullback. So what are we doing? We're just waiting. This is not a time to be fully invested in the stock market. That's what our technical analysis is showing. Research company, not only the research we're getting from them, but many other Wall Street strategists are saying, look, we're seeing a weakening in the economy. Walmart announced they're going to be cutting prices. Why? Because sales are just not happening. So lots of negative information. Remember, the stock market is very news driven. Anything could set it off either to the downside or short term to the upside. So we just have to be patient. I think the word of the day or the week is patience. Patience. You will be rewarded once the economy or the stock market turns, either way, but most likely the probability is that there will be a pullback. So hope you enjoyed the video. Please give me a call if you have questions, concerns, which direction, what we're thinking. But at this point, we're just sitting on the sidelines. So thank you for watching. Have a great week, and we will see you next week. Take care. Bye now.